Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, Head of UK Rate Strategy, and I'm joined today by our global market specialists, Giles Gale and Cummins. Another week of lots of market volatility. I can't believe it's only been a week since we last recorded Bondcast. It feels like so much has happened since then, but I guess it's been a week that, compared to certainly when we were recording this time last week, feels characterised by markets regaining a little bit of composure after the weekend's events. And then in the latter half of the week, we've obviously had a lot of focus on central banks, with the Fed and the Bank of England meeting on Wednesday and Thursday. So perhaps, Kevin, we can start with you on the US side. That's where, these kind of concerns around financial stability began. And we spoke a lot with Jan last week about how we thought it would be prudent for the Fed to not hike rates against that backdrop of quite severe market volatility, but also a tightening in credit conditions. In the end, they did deliver a rate hike, a smaller one than we perhaps might have otherwise expected, 25 basis points. What was their rationale for doing that? Why did they decide to hike rates at this meeting versus, what we thought would make sense for them to at least pause?
Yeah, well, I think in general, the market pretty much priced it in. So they kind of delivered and followed through on their expectations that they had in their dot plot back in December, that they're going to continue, given the backdrop of inflation, to continue to move forward. So it was kind of a hike with some dovish undertones, a tightening light sort of message. The reason, I think, is that they probably saw the fact that if they hiked now when they have the opportunity to, then they may not have to hike as much down the road if inflation were to remain sticky, and there potentially could be less fallout on the economy if they get to the level quicker now rather than having to do more if they feel like they're falling behind. The other worry, I think, too, is just a broader concern. Is the Fed losing their resolve on inflation? So they probably are more concerned that if there was fallout on inflation expectations or, longer term interest rates in general. So that was probably enough reason. I mean, in the Q&A, Powell was asked whether or not a pause was considered. And he acknowledged that it was. And in the last few days, they've been talking about that as an option. But said there was a strong consensus. It was a unanimous vote. So I think as a show of support for the chair, everybody on the committee went along with it. But I think in 3 weeks time, when we get the FOMC minutes, there probably is going to be a difference of opinion. Because I think, in general, it was a lot of uncertainty going into the meeting, that we haven't had a meeting like this where there was, yes, the market was pricing it in, almost fully priced by the time of 2 p.m. But I think there was still that level of uncertainty whether or not, well, maybe they will surprise to the other side and, put things on pause right now. But I think the fact that they probably took that option of delivering on 25 probably gets them to a point where they can go on this extended period. And I think, in their projections, they showed another hike for the terminal rate of up to 1.25. But I think that hurdle's probably higher now that they got to this move. And I think you probably have to see the data outperform, that inflation for the core CPI. They'll only have one report before early May when the Fed meets again. Probably has to surprise to the upside for them to actually deliver. There's obviously a lot of time between now and them, 6 or 7 weeks from now before they meet again. So, we'll see how things evolve in markets and if there's, more signs of stress in the banking sector between now and then. That's, it's almost unpredictable now what they're going to do in May, given the backdrop.
Yeah. How important are those kind of financial sector uncertainties then? And how have they really influenced Powell's assessment of, the inflationary backdrop, I suppose?
Yeah, I mean, in the statement itself, they did directly made a reference to tighter credit slowing economic growth, inflation, and financial markets. So I think, they are keenly aware that tighter lending standards that, we only get the senior loan officer opinion survey a few times a year. And the latest data that we have is from a survey in January. And that showed, as the Fed was hiking rates, there's been a significant tightening in lending standards, and access to credit is going to become much more restrictive in the wake of the turmoil in the banking industry now. So the Fed is well aware that this tightening in lending standards is going to slow the economy. I mean, you got to look at those estimates that they came out with, as take them with a grain of salt, because they really didn't change their economic outlook. I mean, I threw out the idea that they may not even put numbers on to paper at this meeting because no one really knows the slowdown that this will have on growth, the disinflationary impulse on inflation. It's just so new. It's only, 12 days old or so. So it's really difficult to have conviction. And the Fed basically punted. They repeated a lot of their forecasts for December, even though now they've sounded much more guarded. Their forward guidance was toned down. Rather ongoing hikes, they soften that language to say some further hikes may be appropriate. So they really left a lot of opportunity for to move in either direction, really, going forward.
I guess you've kind of a little bit already answered that question, and certainly with what you were talking about in terms of the inflation print and there being a huge amount of uncertainty with the data in the next 6 weeks ahead, and that's what's going to influence whether they hike again or not. But am I right in saying that it's your base case now that we've reached a peak, and perhaps more importantly than whether they hike 25 basis points at the next meeting or not, the market now is looking for quite a dovish pivot? It's got a fair amount of cuts being priced in beyond the next meeting. Is that right, or would you push back against those cuts that are being priced?
Well, yeah, as I said, the Fed's estimate is one more hike. I do think the data have to outperform, particularly on the inflation side, and things have to remain fairly stable in markets for them to actually deliver another 25 basis point hike. The inflation backdrop doesn't appear to really swing to a more dovish stance for a while, that I think, assuming that we don't see a significant immediate retrenchment in the data on the growth side, that will allow them some time to evaluate things before going that aggressively and starting to cut rates. I mean, if you look back at earlier tightening cycles, for example, over the last 6 tightening cycles, the months between when the tightening cycle ends and easing starts, on average, is about 7 months. So the market is well aware of this, and that's why they're aggressively expecting that this probably was the straw that broke the camel's back, and that people feel much more comfortable with the idea that we're going to tip into a recession at some point this year. The Fed's own forecast, I understand the Fed's not going to go out and start forecasting a recession. They've only really modestly lowered their growth projection for this year from 0.5% as of December to 0.4%. So it was no revision there, or at least meaningful revision. But I think the Fed, oftentimes when things change, they're a little bit slow and they continue to talk about tightening rates, and things can unravel very quickly and the Fed will act and start to cut rates. So, the Fed acted. One of the things that Powell laid out was initially they ramped up and went very aggressively on rate hikes last year. He then switched the narrative to saying, we're going to get to a terminal rate. Once they get to that terminal rate, they want to go on an extended hold for a while. In our own forecast, we haven't changed our expectation that they're going to necessarily start cutting rates anytime soon. So right now, we don't see the first rate cut until the first quarter of next year. So about 12 months, if we're right and we've reached a 5%, by 12 months or so from now, they'll start to cut rates. We've penciled in 50 basis points, but I think that clearly based on Fed history is that they're going to go quicker than what we have right now. And certainly, more than what potentially the Fed is expecting to do, or at least going to, talk about the having to continue to raise rates now. I think the hurdle for them to go past, even if they did hike in May, past that is a much higher hurdle than we're probably close to being done right now in our own forecast.
Okay, that makes a lot of sense. Thank you, Kevin.
Imogen, I think it's your turn now because there was also a lot going on in the UK this week. Maybe we should start with the inflation surprise that we had earlier in the week, and you could just give us the view about what was behind that and what all that means, thinking about inflation ahead.
Yeah, I guess the inflation data in the end was kind of the big market mover in the UK this week. Well, in part because I guess it came before the Bank of England and gave us a pretty large clue about what the Bank of England would ultimately do. But yeah, that inflation data came much stronger than expected, both on the headline and the core measure. And I guess that's probably what's more important really for the Bank of England, is that strength and stickiness really in the core component. There was a lot of chatter around what really drove the upside surprise, and some school of thought that this was perhaps a Valentine's Day boost, given the way that the index is calculated and which particular date it takes on any given month in any given year, and that a lot of the rise was being driven by alcohol prices, but particularly alcohol prices or alcohol that was being sold in restaurants and bars and hotels. But I think there's more to it than that. The upside surprise or the price pressures were a little bit more broad-based than that. We saw food price inflation rebound and clothing and footwear as well. So less, I suppose, typically Valentine's Day related parts of the inflation basket also saw kind of upside pressure. And the data has been more noisy than you would usually expect around the turn of the year as well. So it's difficult to infer too much of a trend, I would say, from just 1 month, and particularly when it's coming from more volatile components like the footwear and clothing sectors. But nonetheless, it does kind of point to some still stickiness in core inflation, which may well prove to be problematic for the Bank of England. So, over the kind of year horizon, it has, forced us to kind of upgrade our inflation forecast marginally. So we now see core about half or just less than half of a percentage point higher than we previously did over the kind of 1 year horizon. And then over the 2 year horizon, we now have it getting back down to 2% rather than just dipping below 2% as we previously had.
Okay, and so on the back of that, as you say, the Bank of England just went ahead and did the 25 basis points that you had been calling for as long as I can remember, to be honest with you. Is that it now?
We think so, yeah. So long-time listeners will know that we've been calling for, as you say, Giles, that 25 basis point hike, which, ultimately seemed, kind of obvious, I suppose, after that inflation data surprise to the upside. But it wasn't that long ago that markets were only pricing in, less than 10 basis points of a hike for today's meeting. I think probably this time last week when we were recording Bondcast, we were somewhere around 10 basis points. And on Friday, it came down a little bit below that. So, it really was a kind of underpriced outcome just a couple of days ago. But the inflation data yesterday, we're recording this on Thursday, so on Wednesday morning was definitely the nail in the coffin, and that 25 basis points was very much in the end expected by markets. It actually was a pretty uneventful Bank of England, I would say, in that hike was delivered exactly as expected. The vote, I think, was exactly in line with ours and consensus expectations at 7-2, with the two doves voting for unchanged. And in the end, the guidance was unchanged. We had previously thought, and I think we probably discussed this last week on Bondcast, that the guidance may well be diluted. If they were confident that they were at the peak in rates, then they might dilute the forward guidance that they currently have around, the need for more rate rises if they continue to see persistence in inflationary pressures. But actually, I think it became pretty evident, given the size of yesterday's upside surprise on the inflation data, that they probably weren't going to dilute that in a particularly dovish way. So, on the surface, it didn't seem like a majorly dovish meeting, or a meeting that they were necessarily signaling that they thought that they were close to the peak. But there was just a couple of details that I think did give it a dovish lean, and I think do sort of vindicate our view that could well be the peak in rates now. The first is that Catherine Mann, so the most hawkish member of the MPC, kind of folded into the 25 basis point camp, if you like. She'd previously been voting for 75 and then for 50, and now she's at 25. Now, we tend not to, given her known very hawkish bias, we tend not to place too much weight in kind of what she says, and we know that she is a hawkish outlier on the council. But I do think she's an important, line in the sand for the most hawkish view on the committee. And therefore, if the most hawkish member is voting for 25, then that, tells you something about perhaps the direction of travel of views on the committee. And the other important point, and this goes back to, the inflation data that we just went through, is the way in which they talked about that upside surprise on inflation and how they expected inflation to evolve in the next quarter. And they said, despite that upside surprise yesterday, which came in higher than their forecast, they still expect CPI inflation to fall significantly next quarter to a lower rate than had been anticipated in the February report. And they also talked quite a lot in detail around wage inflation and pay growth, and the survey data that's starting to show kind of a downtick, if you like, in different measures of pay growth. And they also say that they think wage growth is likely to fall back somewhat more quickly than had been projected in the February report. So despite a sizable upside surprise to inflation yesterday, they actually seem fairly relaxed about the inflation outlook. And if they are right that inflation is going to come off very quickly and rapidly come back down to their target, then I think that they probably are done with hikes for now. That's not to say that the risks aren't still skewed to the upside. And I think yesterday's inflation data, re-emphasized the fact that those risks are probably skewed to the upside. So my risk case would be, an additional hike in May. But beyond that, as we've discussed on this pod before, I think that it does come down to the wage inflation outlook and the extent to which the tightening that they've already delivered gets felt to the real economy, and the impact that has on the consumer and the headwinds that delivers. But that won't really become obvious until, the end of this year. So if they do need to hike rates beyond 4.25%, 4.5%, it may not be until early 2024 that we actually see those hikes being delivered. So I would push back a little bit against the market that has, kind of 100% chance of another hike being priced in by kind of August, but then also a cut very quickly thereafter. And I think both of those are probably being overpriced right now.
Okay, my last question to you then is just, I guess it's about flows, because tomorrow we have the Bank of England and with their QT announcement and the DMO's remit. And on top of that, you've just written a big report about sort of thinking through all the sectoral flows and so on and so on and so on. So maybe you could just summarize all of that for us. What means for your gilt lead?
A nice little teaser for anybody who receives our research. That will be dropping in your inboxes shortly. Listeners of this podcast will know that we've long been kind of banging the table on this kind of supply-demand imbalance story when it comes to gilt issuance next year. And I think that, as you rightly say, Giles, the two calendars that we will get tomorrow won't bring anything new to the table necessarily, but just serve as a reminder of how heavy the issuance outlook is going to be. So we'll get the fiscal year Q1 calendar from the DMO. And really the kind of important details for that, I guess we've already had both in the remit last week, but also in the minutes from the quarterly meeting with GEMS and investors earlier this week. Again, the points that I would highlight from that were just really the concerns around the kind of near-term demand, particularly on the linker side. We talked last week about the fact that linker bucket was much bigger than we expected, but also that they were doing an additional syndication on top of what we had expected. And that syndication was coming much earlier in the fiscal year than we'd expected. And I think the minutes from the meeting, certainly on the investor side, really highlighted those kind of demand side concerns. So I expect, the DMO's issuance calendar to just confirm the fact that it's a very heavy supply schedule over the next quarter. With this 17, I think I'm right in saying 17 auctions from the DMO, and 2 syndications in the first quarter of the fiscal year. And then we also expect the Bank of England to announce slightly larger auction sizes, so 675 or 680 million per bucket, we think, which is higher than the 650 million they've been doing this quarter, but also more auctions in the quarter, so 6 in each bucket rather than 5. And if I do some quick math, that tells me that there's going to be more days in the quarter ahead with auctions or with kind of issuance events than there are going to be without. And I think that, listeners will know that I think that that's going to be a big driver of gilt yields in the months ahead as that weighs and the market starts to feel some degree of supply saturation. And it's not just, referring to the note that you're talking about, Giles, it's not just about that heavy supply outlook, but really thinking about which sectors are going to absorb all of this supply. And it's not obvious to me that the kind of natural buyers, when, we think of gilts in terms of, pension funds at the longer end of the curve and overseas investors out to the kind of belly, are going to be able to increase their demand to keep pace with that additional supply. And the scope of kind of bringing in new sectors of demand, whether that be through, or growing sectors, I should say, whether that be kind of retail and household investment or insurance rather than pension companies, pension funds, I should say, sorry, or even bank treasuries. It's not obvious to me that they're going to kind of step in any significant way either, without a significant cheapening, I should say, in gilts. So we retain that bearish bias in longer dated rates and think there's still quite a significant upward shift in yields to come. But I've said that enough times on this podcast, and I've certainly written that enough. So let's switch over to Europe and think about the ECB. We obviously discussed your kind of hot off the press reaction last week, recording it immediately after the meeting, with a week to kind of let the dust settle, and certainly with other events to kind of happening over the week. How do you feel about what the ECB did last week now and your kind of rate call for the months ahead?
Yeah, I mean, to be honest with you, nothing has really changed. In fact, markets have been sort of regaining a bit of composure this week. And, with that, I think that the call that we made that the ECB probably has another rate hike in it in this cycle, maybe 2. The market seemed to be closer to 2 now than to just the 1. I struggle to see pricing now, given everything that's happened, going back to significantly above 3.5 as a terminal rate. But I think that around where they are at the moment, say 3.4-ish, that would be kind of the midpoint of where I would say is a sort of fair value range for that peak, would be sensible. And the pricing for that being around September, that also seems sensible to me. So I'm pretty comfortable on that side. And then when it comes to the long end, again, no change in what we're talking about there. No, at least in terms of the peak for interest rates through this cycle. Very similar logic to what you were just going through there, Imogen, and neutral. So all those who listen to Bondcast regularly will have heard me sort of touch off those arguments in more detail, but I think we can be for another time. But I'm still perfectly comfortable with our target of 3.25 for 10-year bonds, for example. No, I think that possibly that's been pushed back a little bit as well because of everything that's happened, and obviously the lower starting point as a result in yield levels. But broadly speaking, as we were. Maybe I just mentioned that as we came up, I noticed that Klaas Knot, for notorious ECB hawk, is now talking about 25 basis points at the next meeting, and or no, to say a hike at the next meeting, but won't pronounce on size, which suggests clearly that's more open than he has been, and I think that is maybe parallel to your Catherine Mann comment earlier.
You think the books have been conversing, have they? Okay, let's cast our minds back to the weekend. As I said at the beginning of the pod, I can't believe that it's actually only been a couple of days since Sunday or Monday, should I say, when we came in. But, and I guess in a slightly more off-piece for Bondcast kind of topic, there's been a lot of talk this week about obviously the merger of UBS and Credit Suisse at the weekend, but I guess specifically what really drove markets on the open on Monday was the treatment of the AT1, so that's the additional Tier 1 debt. What do you make of that, and I guess the implications for that market going forward?
Well, I think the first thing to say is that there was, I think that just having dealt with that big question that was really hanging over us last week, should have been cathartic for the market, and has proved to have had been. And then there was this question, there was this sort of follow-on question of the AT1 market in particular, and whether sentiment there might have sort of spread into other sectors. I don't want to spend very long talking about this because it's a subject which obviously makes some people very cross. I'm sure we haven't heard the end of it. But just to summarize for those who might benefit from that summary, what happened was that the Swiss rules seem to they allow AT1s to be written down entirely in what they call a viability event, which includes the need for any sort of substantial public sector support in order to underpin the viability of the institution in question. So while in an insolvency, the expected capital hierarchy would presumably have been respected, and I stress, I'm not the bank's analyst. I'm not the expert on this, but I say, given my knowledge, would presumably have been respected. This wasn't an insolvency; it was the non-viability which triggered the write down. And I'm again told that this was all reasonably clear in the BRRD, the regulation, the European regulation, and also the instrument conditions. Admittedly, perhaps not everyone is fully on top of all of that, and there is a sort of rule of thumb that bonds are supposed to be senior to equity, and AT1 they were bonds, right? Anyway, so the Bank of England and the ECB / SRB have since sort of clarified that the treatment of this class of bonds in insolvency or resolution would be respected. But I think it's important to remember that this wasn't an insolvency or but I think again, there are other wrinkles in here, other things that matter. For example, the Swiss case, the bonds had the terms allowed for permanent write down, whereas the norm is equity conversion or temporary write down. So again, I think that as people thought through all of these things, there was some composure, which has been followed through on, and where we're left, it is roughly speaking 8% down from when all of this turmoil in this specific market, 8% down compared to where we were before everything started. When the turmoil really started.
Yeah.
But we've bounced 8% from the bottom. So at the worst point, I guess on Monday morning, we were down about sort of 15 or 16% in that market. And just one final point on context and the potential of this or other things similar to this to really sort of propagate through market. It's a 250 billion market, roughly speaking, market value. in Europe, that is. And that's big. That's sort of, two Portugals or something like that. But but it's not enormous in the context of the European bond markets, and so maybe that's enough on that subject.
I like that. We should start thinking of all things in terms of Portugals. Okay, so moving kind of completely away, I guess, from what has really driven market volatility this week, but certainly not necessarily any less important. There's also been a bit of political noise, let's say, in Europe this week. Does any of that really matter?
I would say no. I mean, we had, just running through them, we had this no confidence vote in France, which, if you live in France or you follow French politics closely, has seemed like a lot of noise. The vote itself was closer than expected, and poses specific problems for example, the schism. There was a schism in the Republican Party. Macron's approval rating is down to basically the lowest it's been since the end of 2018, and I think it was, when I checked earlier, about 32%. But don't forget that the next election in France is not until 2027, and an awful lot can happen between then and now. And this was, and it was always expected to be, the most difficult point in this legislature. So I would say no on that front. The other ones were, there was a Spanish vote of no confidence as well. I don't have to go into the reasons why. I think that the bottom line here was that compared to the French one, which was clearly very difficult for the president, this I think was actually more of a success for the Spanish government. The timing wasn't probably that much of it's not that much of a coincidence that it comes just before local elections in May, which I think maybe certain actors were hoping might give them the right kind of exposure and the right kind of momentum then for general elections in December. But I don't think this is the kind of thing that's going to upset markets, or should do. And then finally, just on the Dutch local elections as well, and that was a little bit of an upset, again, without going into the details. The repercussions of this is that the local elections then determine how the Senate is chosen. And of course, what markets care about is the pension reform, and that has to be dealt with in the Senate. And now, I guess the upshot there is that there's a time. The time frame is that there were certain decisions that needed to be made to keep things on the right time frame for July 2023. Yeah, it's about 4 months' time, 3 months' time. I think it looks likely that gets pushed back into December, but let's see. It seems like there's a little bit more pressure on the Dutch pension funds, perhaps to accelerate some of their hedging, which of course, with higher rates they have been doing anyway, although it seems like they were more aggressive at the end of last year than they have been so far this year. Now, I've seen a couple of things looking at the hedge ratios, which are all much better. These are PVO1 hedge ratios in the Dutch pension sector. I don't think that has been so much to do with aggressive hedging by that sector, but just the mismatch in asset versus liability convexity, which has naturally tended to close that gap as rates have risen.
I did wonder how in depth you were going to go on that. That is certainly enough for Bondcast. All right, great. Thank you both of you for joining me, and thank you for our listeners for tuning in. Just a reminder that if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Here's to hopefully a quieter week next week. Thanks. See you then.